This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Carol Massar along with Matt Miller. Matt is in for Tim, who is off this week. And I know, Matt, there is so much going on, but I've been thinking about earnings that we've been talking to a lot of CEOs. I mean, they're crushing second quarter expectations, up 9.1%, triple the preseason forecast. Mind you, those forecasts were brought down a lot. It's the strongest beat rate since 2021. That's according to our data here at Bloomberg Intelligence. So I don't know, like when you're thinking about fundamentals, that seems to be a big one.
Yeah, for sure. I mean, as we know, companies always beat, right?
Because they manage.
Usually it's, I think, 76%, and now we're looking at a bigger amount, 82, right. 83%.
But it was negative because people were really worried about the tariff impact.
Absolutely. So if you look at EEG, you get the earnings estimates, and you can see that they just plummeted after Liberation Day, and we were only expecting like 4% growth. Now we're looking, as you said, at about 9% growth. It's actually 8.87 of the 398 companies that have reported so far. I'm looking at the EA screen, which is a really good one as well.
Thank you very much. Getting those statistics right on the money.
Top line growth up as well, almost 6%. So.
Which is always important, right, in terms of what's going on in revenues. That's what we want to see. Hey, as for this hour, we're going to talk a lot about Apple. Stock up as much as 6% in today's session.
Adding 20 points alone to the S&P. So Apple is, a big company, and it's really swaying. I mean, we're only up 44 points in total. So Apple's adding about half of the gains on the S&P right now.
And we're going to talk about that impact specifically on the broader market. That's going to happen our 3 o'clock hour. But this hour, we're going to talk about why it's up. Investors very much looking at some expectations about some news from the president later on about an Apple investment.
It's like opposite world. Have you noticed that?
What do you mean?
Investors, if you tell investors you're spending more money, like CapEx is up 20%, they buy the stock? What is up with that?
That's a good point.
I mean, the announcement is $100 billion extra in spending, right?
Maybe the White House, there won't be so much heat on me and my company, right? Especially a company where supply chains are so important.
But the same thing has happened with Google and other hyperscalers. When they were supposed to spend $75 billion, they said, you know what, we're going to spend $85 billion this year. Investors bid up the stock.
We promise there's a show to come once we get through our teas. We're going to talk Apple. We're going to talk OpenAI's valuation. We're going to talk how it's not so magic over at the Magic Kingdom. We've got a tech company that Matt talked about big time in the aftermarket yesterday. We don't necessarily, but man, it is soaring. And then we're going to talk a little distressed real estate. So
you talking about Arista? Okay.
Do you know what a tease is?
Yeah, I got you.
I try. All right, let's get to the market trade on this Wednesday. Let's toss it over to a very, very, very patient Amy Morris. Take it away.
No problem at all, Carol. Thank you so much. President Trump highlighted great progress made in a meeting between his envoy and Russian President Vladimir Putin. Sources say the Trump administration is now considering new sanctions on Moscow's covert fleet of oil tankers and several entities that enable them to operate. Ukraine says the shadow tanker fleet is the backbone of Russia's ability to finance the war and avoid sanctions. Right now, WTI is down 0.4%. Brent crude is down 0.3%. Let me make a quick correction. WTI now down 0.7%. Look at that. Let's check the markets. We do it all day long here at Bloomberg. The S&P 500 up 0.75%. NASDAQ up 1%. The Dow is up 0.3%. The 10-year Treasury yield at 4.24%. The 2-year yield at 3.72%. Global sales at McDonald's restaurants rose 3.8% in the second quarter. That company says it's looking to bring back low-income diners in the U.S. since they eat at restaurants more than middle and high-income diners. Shares of McDonald's 3.6% higher. Novartis has reportedly made a takeover approach for rare disease-focused biotech Avidity Biosciences. The Financial Times reports Novartis has been evaluating a bid and expressed interest in an acquisition in recent weeks. Avidity is working with advisors to assess its options. Shares of Avidity now about 24% higher. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Bloomberg Businessweek Daily with Carol Massar and Matt Miller.
All right, got it. Amy, thank you so much. All right, we're all in on tech. Older tech, new tech. We're going to talk about OpenAI's possible valuation. We're going to get to that in just a moment. We got to talk about that Apple, Matt.
Yeah, no, absolutely. I mean, look, it's a $3 trillion company.
I kind of hesitated because it's like old, new, like it's all kind of crisscrossing.
Apple is definitely high tech still.
Definitely
it's not the printing press.
But is it old tech or is it new tech?
No. I think Apple is, as much as we sort of joke about or talk about the fact that they don't seem to be on the forefront of AI, they still are doing things that amaze us and change our lives for the better, right?
And that everybody uses as a benchmark. We're also focusing on what seems to be an announcement that's expected to come from President Trump around 4:30 p.m. Wall Street time about another big investment by Apple into the U.S. Lots of questions. We knew we needed to kind of get a reality check once more from Bloomberg News managing editor for global consumer tech. We're talking about Mark Gurman. He's out there in L.A. Mark, good to have you back. Apple shares, investors are bidding it up more than 5.5% as we speak. We've talked about these investments that Apple is doing in the United States previously. Some were already, I think, announced. But this isn't about bringing the iPhone supply chain to the U.S., is it?
Here's why the stock is up. Stock is up because investors, I think, this is just a guess, know exactly what's going on here. This is marketing. Tim Cook, the CEO of the world's greatest marketing company, is telling Donald Trump, who wants to tell his base that he's getting the biggest company based in the U.S. to do whatever he wants, that they're going to be doing more in the U.S. The reality is that Apple invests billions per year already in the U.S., right? They make glass through Corning in Kentucky for iPhone screens. They manufacture with a company called Finisar Face ID components, that's for 3D facial recognition scanning. They do some chip production in Arizona. And so Apple is earmarking another $100 billion, we're told, to a total of about $600 billion over the next half decade or so for US-based manufacturing. They're gonna put a fancy name on it, right? They're calling it the Apple Manufacturing, something related to Apple Manufacturing, US Manufacturing, American Manufacturing Program, AMP, I believe Apple's gonna call it. The reality is, unless they announce that they're building plants in the US to do final assembly, to do mass manufacturing of iPhones and Macs and other products, they're not doing what Trump has been talking about for years. They're not doing what we've been talking about for years. As far as I'm concerned, I don't believe that's happening, but anything short of that, this is more marketing.
Do we know, I mean, $100 billion is a heck of a lot of money, but are they spending that in 1 year? Or are they spending that in 5 years? You know, are they adding that to the, haven't they already earmarked $500 billion to spend over the next 4?
Yeah, they've already earmarked $500 billion. So they're going to add to that. We don't have the exact details yet because obviously Apple has not put an announcement yet. Trump and Cook haven't made their joint Oval Office announcement yet. But in all likelihood, this is going to be about further investments in companies in the U.S. doing manufacturing and R&D and development of components that are then flown to China, India, Vietnam, Malaysia, Thailand, to then be mass produced in Asia to be sent all around the world. Now, I want to be very clear. I'm not criticizing Apple's manufacturing strategy. Obviously, Apple's manufacturing strategy of production in India, in China, and elsewhere in that part of the world is the only way that they are able to produce the quantity that they produce today, at the fit and finish they produce today, and the cost that they produce today. There are so many reasons why mass production in the US is just not feasible. But I don't want anyone to be under the belief that a change is going to be happening this afternoon where all of a sudden iPhones and Macs and iPads and watches can be made in the US. If Apple is able to say that and then execute on that, I will be hugely surprised. But my belief, this is going to be a lot of spin and more of the same. And the background here is obviously tariffs. Those smartphone exemptions are running out. To date, Apple has basically said in total across last quarter and the current quarter, about a $2 billion headwind because of tariffs. That's absolutely nothing, right? That's like Tim Cook could sleep 14 hours a night knowing that they're going to get taxed $2 billion a quarter. The problem is that those exemptions are going to start running out and Apple wants to avoid that. So how do we avoid that? We make a deal. I'll come to the Oval Office as Tim Cook and say, we're going to do more in the U.S. We're going to make Trump look good. Trump will be happy, maybe give us some exemptions. So we'll see how it all works out, but that's exactly what's going on here.
So transactional. And it's just getting some of the heat off of Tim Cook and Apple.
Textbook definition. Yeah, getting the heat off of Tim Cook and Apple. We'll see if it works, right? Donald Trump can say anything in that Oval Office meeting. Tim Cook can say anything in that Oval Office meeting. We'll see how it goes. This is a tried and true playbook. Tim Cook has done this with Trump so many times, and it's basically worked every time. Apple has never been largely impacted to any material degree by any of Donald Trump's policies or tariffs, either in the first administration or thus far in the second administration.
All right, let's talk about the fun stuff now. The products, right?
Go.
You mentioned the Apple Watch. Obviously, we're both using iPhones. I was on an iPad this morning. I have a Mac at home. I just tried to buy a Thunder Max ECU for my Harley Davidson, and I found out it only works with Windows. And I thought, people use Windows? How much market share does Apple actually have? Because Carol and I live in this ecosystem.
Yep, Apple homes.
We don't even think of, Android products, but people do use those.
And like them.
Well, the U.S. is basically half and half. It tilts a little bit more to Apple when you're talking about phones. Tablets, Apple is really the market leader. Smartwatches, Apple's the market leader by far. When you're talking about computers, right, in the US, they have pretty good market share, but on a global level, the vast majority, close to 80% of the market is still dominated by Windows. But they have made strides. And, the most important thing with the Mac is people keep buying them. People are holding on to them. People are sticking in the ecosystem. And they're buying more iPhones and iPads because of it. People get exposed to one product. They want to buy other products.
30 seconds. Does Tim Cook hate all of this?
Well, I don't know how Tim Cook feels. I mean, if I were Tim Cook, this is kind of exciting, right? Get to go to the Oval Office, get to have a press conference with the president, regardless of who the president is. I get to usher in all these new products. Apple is dealing with some complexities right now with AI. Not everything is going well. So it's kind of exciting that he gets to kind of put his foot down right now and try to hammer people home that something needs to change. So no more coasting.
I'm guessing he loves his job, and this is just one exciting part of it.
Well, I have to say, investors pretty excited too, because as we said, this is a stock that has definitely lagged some of the other Mag 7 and big tech companies. Right now, up about just shy of 6% here in the trade.
Well,
Mark,
this year, second worst performer and of the Mag 7 companies, and over the past 5 years, second worst performer.
Yeah, but a little bit more positive sentiment right now.
Yeah.
Just in this day. All right, Mark Gurman, thank you. Mark Gurman, of course, Bloomberg News managing editor for global consumer technology. Mark mentioned AI and Apple, and that's where they have struggled, but that's not necessarily the case, not at all, when it comes to OpenAI, which is in some early talks about a potential sale of stock for current and former employees at a valuation of about $500 million, this is according to people briefed on the investment discussion. And we have another story on OpenAI. We'll get into that in just a moment. Always a lot when it comes to OpenAI and AI in general here at Bloomberg. Let's get to it with Shirin Ghaffary. She is Bloomberg News AI reporter, and she's out there in our San Francisco bureau.
And she's knocking it out of the park lately.
Shirin,
we were talking about your story yesterday with Kate Clark, and now I've seen your name all over the terminal. Your byline is everywhere.
Listen, the AI beat keeps us busy. There is a lot to report on these days.
We'll talk about OpenAI. It seems like the popular kid in the AI world. Tell us about this possible share sale, what it means for its valuation, why this is happening at this point.
That's right. So this, it's still early talks. Things could change, but as we reported, OpenAI is in discussions to do a secondary sale of its shares at a $500 billion valuation. This would be for current and former employees. And as we reported, Thrive Capital is in talks to participate. So, meaning to, actually buy those shares from employees potentially. So this would be a huge jump in their valuation, right? 2/3 markup. And so it's really notable and just a sign of how highly valued these foundation model companies are becoming.
I get the valuation and the expectations and the exuberance, irrational or otherwise, but I mean, what is this, I understand the business too, the partnerships, the Microsoft involvement and investment. Is it profitable? Will it be profitable? Like, what do we know actually about the business fundamentals right now?
So revenue's growing, but it's still not enough to, for these foundation model companies, they are training these models that can cost billions each time, right, to put out a new GPT-4 or 5, or same with Anthropic. So it, may be a while before we see them actually reach profitability. Why? I mean, the bullish argument for this is that they will get there, and they're growing so quickly, and we're seeing revenue grow so quickly that this makes sense. But obviously this is going to have to pencil out at some point, and yeah. I pay them like $240 a year personally. My company, I have a subscription here at work as well, Shirin, that's got to cost a similar amount. But they're offering government federal agencies $1 a year subscriptions, which is cool. But are they doing that for market share? Are they doing that for access to data? Are they doing that for influence? What are they really after with this strategy? Yeah, look, I mean, they want to get ChatGPT in the hands of as many people as possible. And if you think about government, that is something, those workers, right, these federal agencies, that's a way to sort of embed your technology into the day-to-day operations of the U.S. government. So this $1 a year deep discount, basically giving it nominal cost almost for free to each federal agency, is a sign of how eager companies like OpenAI are to get government workers using and relying on their tools.
We're about to get GPT-5. I'm super excited.
You are?
I'm on 4.0 right now, and
Do you
I'm
notice
hearing
a big difference when they
huge difference.
Okay.
Huge, and also what you prompt is incredibly important.
I've heard that, like, in terms of the questions. Yeah.
But Shirin, do we know what kind of leap it's going to be to GPT-5? When it's going to be released, roughly?
Well, I can say it's widely expected soon. There are lots of rumors, but all these companies right now are really chasing after a few things. One is coding capabilities. We've seen Anthropic really make a lot of advancements in this in the past year, and so Google, OpenAI, everyone is trying to make sure that their models have equal or better coding capabilities. The other is on the agentic front, right? These companies, they want their tools to not just be able to talk to you, but to actually do things for you, to buy things for you, to program things for you.
Yes.
And so if you make an agent and those capabilities, that requires sort of additional complexity. So that's another big area that we're expecting improvements on.
Are we going to be able to get that? Like, can I send out ChatGPT to buy me a plane ticket, say in 6 months, Shirin? What do you think?
Listen, I do something that I call the burrito test, where I go and test all these agents and see, can they just order me a burrito? And you'd be surprised. Even a simple task like that is a lot harder than you think, because it involves going to a website, putting in your information, getting credit card. There's a lot of, so even if the AI is smart enough to know how to order a burrito, can it actually interact with the real world in a way that isn't full of friction?
But isn't that where it's got to go in order for all of us to kind of be all in? I mean, this whole idea of kind of everybody having their own little assistant, AI assistant, that's where it's going, right? Just quickly.
Totally, and I think that if these things will work will depend on if they can integrate with the rest of society, if they can figure out a way to hook up to all the different apps and websites and in one day the real physical world out there, not just live in a box.
And are we okay giving up kind of all of that ability and access? Shirin Ghaffary, Bloomberg News AI reporter, joining us. Hey, coming up, we're going to take a look at some stocks on the move. Some you know, some you don't. We're talking earnings in a big way. A little Disney, a little super micro actually. That's next.
It's 2:21 on Wall Street. I'm Amy Morris. Let's check the markets. We do it for you all day long here at Bloomberg. The S&P 500 up 0.75%, NASDAQ up 1.1%, and the Dow is up 0.3%. The 10-year Treasury yield at 4.23% and the 2-year yield at 3.71%. Supermicro computer shares are 19% lower after it lowered its fiscal year revenue forecast to at least $33 billion. The company's revised fiscal year outlook raises questions about its ability to capitalize capitalize on demand for AI equipment with the latest NVIDIA chips. Apollo Global Management will acquire a majority stake in Stream Data Centers. The deal will allow Apollo-managed funds to potentially invest billions of dollars in digital infrastructure. Apollo shares right now 0.5% higher. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Bloomberg Businessweek Daily with Carol Massar and Matt Miller.
All right, Amy, thank you so much. I mentioned we were going to take a look at a few stocks that are on the move in today's session. Supermicro, it's down about 18% as we speak, plunging the most in about 9 months after the company lowered its fiscal year revenue forecast, raising some questions about sales and pricing pressures around powerful AI servers. And then there is, I think it is still the top performing name in the S&P 500 today. And we're talking about Arista Networks. It's up, Matt, 18%, surging following earnings. And it was a stock.
Coincidence?
What do you mean?
You just said Supermicro was down 18%.
I don't know. Coinky dink? I don't think so.
Obviously.
We should point out that Arista, that stock has more than doubled since April, reaching an all-time high today, making its CEO one of the world's richest women. So let's get a wrap on both of them. Important names, important stories. We head to our Bloomberg Intelligence headquarters in Princeton, New Jersey, and to BI senior hardware and networking analyst Woo Jin Ho. Woo Jin, good to have you here. First up, Sun Micro, stock down a lot, as we mentioned, down about 18%.
Wait, Supermicro?
Supermicro, what do I keep saying?
Sun Micro, that's from the days of Cisco. Are we in the internet bubble?
I'm really sorry. What happens is when you're around a long, all these names kind of merge together. Supermicro, ticker is SMCI. I know I keep doing that. Let's start there. So, Woo Jin, what do we need to know? What's going on with this one, and why is the stock down so much? And do investors have it right?
Sure. Hey, Carol. So there is a couple of things, right? The stock's down for a couple of reasons. Number one, their $33 billion, quite frankly, is actually up 10% above consensus expectations. However, one of the fiscal 2026 markers that Supermicro laid out back in February was $40 billion. So if you think about the run-up from, I guess, a trough back in February all the way up to pre-results, we're talking about a 200%, 300% gains, and people were expecting that they would bring back that $40 billion. And, $33 billion is a big disappointment to that $40 billion. But more importantly, and you clued in on it on the lead-in, is the pricing pressure and the impact to gross margin and operating margins. Consensus had them at around 7% operating margins for the year. That seems that it might have to come down primarily because of competitive pressures. And, when I run the back of the envelope math, I don't think that they can do above $3 in EPS if they do deliver that $33 billion for the year.
And just to his point, to Woo Jin's point, stock's up about 53%. Year to date, so it's been on a tear.
Well, this stock was a $120 stock 2 years ago.
That's true.
And I'm really impressed that an 18% drop is the biggest since 9 months ago, because I thought it would be a stock like Open Door, where it moves up and down 18% every day. So at least there's that. Arista Networks is one that we don't talk about enough, and I'm guessing this is what you meant.
Yeah, that
right?
was my tease. I mean, you were kind of having some fun about.
I was joking about it yesterday because I think of it as a music label that Clive Davis started years ago with Aretha Franklin and the Grateful Dead eventually. But
correct.
No, this is a cloud networking company, and it's up by a fifth today. Market cap $175 billion. Why do you think, Woo Jin, do you guys talk about this at your office all day long?
I talk about Arista, Jayshree, 24/7, Matt, along the lines of Aretha and Whitney.
the old Arista.
Well, tell us what it is that makes them so interesting and why you talk about them so much.
Jayshree Ullal is the CEO, the chairman of the company.
Yes. I've known this company since pre-IPO, and essentially what they specialized in is high-speed, high-performance networking. It started off from the trading floors back in New York to get every microsecond, millisecond for their trade execution, and they've moved into the cloud and high-speed networking, right? So essentially what they start to benefit from over the past year and a half or so is getting into the high-speed networks to support AI networks. And their marquee customers are Meta and Microsoft. Their newest marquee customer is Oracle. Three names that are in the thrust of what AI is going to be over the next several years, and Arista is going to benefit from that.
All right, so can it continue the kind of run that we've seen here from Arista? I mean, I look at this chart and it's gone hyperbolic this year. There was a dip, obviously, but over the last 5 years, it's up 842%.
Yeah, I mean, look, a couple of, some of the reasons why it's up 842%. And if you go back 5 years, if this is pre-AI we're talking about, Matt, this is market share gains away from larger players like Cisco and penetrating into the cloud, defending their turf against these low-margin white box vendors. And they've been growing at a fairly good clip at around 20-25% on an annual basis. There aren't many companies that's able to do that, right? And on top of that, they have software-like margins. I don't know many hardware companies that have about mid 40% operating margins, not gross margins, and continue to grow earnings faster than sales.
I mean, I love Biz Carson of Bloomberg News wrote this story. In the artificial intelligence gold rush, even pick and shovel companies like Arista Networks are seeing their fortunes swell. So, it's just so interesting.
What do you mean even?
Even.
You want to buy the picks and shovels first.
Well, I know that,
Yeah.
but I'm just saying again, going back to it's not a company, right, we talk a lot about, but it just reminds you, right, of kind of their important role in all of this.
Yeah, and Carol, if you think about it, there are a whole slew of small, mid-cap, and soon to be large cap companies that are really benefiting from this this AI boom. There's this ecosystem of smaller companies. A couple of my colleagues cover companies like A-Lab that's up I think 23% today. Celestica, which is a Canadian networking vendor, and that stock has tripled about 2x, 3x over the past year or so, all driven by AI.
Yeah, it's kind of fascinating. I'm taking notes here because I want to analyze.
I know you are. I know you are. You're giving her gainers, and A-Lab is definitely a good one.
We will continue. We will continue. We got to run. We could certainly spend more time, and we'll have you back real soon. Of course, that's Woo Jin Ho. He is Bloomberg Intelligence Senior Hardware and Networking Analyst. All right, from a tech company that we don't, but probably should be talking a lot more about, to an iconic corporate brand company and stock. It's a company that continues to kind of mesh its long-standing businesses with new ones and kind of evolve along the way. We're talking about Walt Disney. Stock is down about 2% in the trade. It was down as much as 5.2% earlier on. Let's get to what you need to know about their earnings and also some of the news that we got early this morning. Geetha Ranganathan is with us. She's Bloomberg Intelligence Senior Media Analyst, again, out there in Princeton, New Jersey at BI headquarters. All right, Geetha, I think initially Disney was up in the pre-market on some of that ESPN news, and then earnings came out, and then it kind of shifted in another direction. Walk us through all of the news flow this morning.
Yeah, plenty of news for this morning, Carol. I actually thought that the earnings was extremely strong. I mean, if you were looking for a beat and raise, you got it. I think why we saw a little bit of that pullback in the shares after they reported was because maybe the guidance raise was not as much as people had hoped for. So they did take their EPS for the full year up to 18% growth from last year, and that compares to 16% is what they had projected earlier. I think maybe the street, the buy side, was looking for something closer to 20% or over that. But really, I mean, the big news, of course, and you spoke about this, the pre-market was, the NFL taking a 10% equity stake in ESPN, ESPN getting control of some of those NFL media assets, including NFL Network and Red Zone. And why this is important, Carol, at this point of time is because ESPN is actually going a la carte. For the very first time, in its history, they're going to offer all of the ESPN TV content on a streaming platform. That's going live in a few weeks, August 21st.
It's a big deal.
And so it makes me so happy.
It's a huge deal.
Yeah.
Wait,
I mean, the reason, Geetha, that makes me happy, and probably everyone else who pays $80 a month for a cable subscription that he doesn't use, is I can now cut that cord completely, because all I want from it is NFL football, and I can just buy that from ESPN Plus.
Yeah, and you're going to get even more of it, Matt. So they're basically really kind of buffering up their whole lineup. Now they get additional games with the NFL Network. You're going to have Red Zone, which is again a huge property on Sunday afternoons. So this really kind of helps them. First of all, gives them much more content. If you're big into fantasy football, again, they're merging the NFL fantasy football with the ESPN fantasy football offering. So there's just a lot in terms of the offering itself. And then if you look at it more from a long-term perspective, Carol and Matt, I mean, just kind of having the NFL as an investor in ESPN, I think just speaks to a much more sounder future. It kind of really is future-proofing the business for Disney and for ESPN.
Why? Can you explain that? Is it just because you're going to have that NFL franchise and you own it, basically? Or got a good friend in it?
Yeah, that's a huge part of it. So NFL, of course, is the premier sports property when it comes to, TV viewing in America. So you're looking at the top 100 broadcasts every year. 80 of those or 85 of those are actually NFL football games. So again, huge. The other thing is that NFL has media deals right now with Disney, with CBS, with Fox, but they do have this opt-out clause. So they can get out of those deals in another 3 to 4 years. And what we think this does, this whole ESPN NFL, kind of equity stake and exchange of assets, is I think it really kind of secures ESPN's future. So I don't think the NFL would ever want to opt out now with ESPN as their partner. Yeah, go ahead.
Sorry, Geetha. I always look at a stock performance over a 5-year. That's my default. Mainly because it's the terminal default when I do the comp function, but also because I think it's a fair window by which to judge pretty much every stock. Now, I'll go for Disney. I'll just go 3 years because I don't think it's fair to include the pandemic. We were locked down. We couldn't go to the Magic Kingdom. But over 3 years, it's still only up 10%. And I hear from Paul Sweeney every morning that the parks business, he probably hears it from you, that the parks business is on fire. So why isn't this company doing better?
Parks is on fire, Matt. I mean, they reported 22% growth, profit growth at their domestic parks, and they have just so much more coming on board over the next year or so. So yeah, it has been kind of a roller coaster, right? Up and down with the Disney stock price. I think the really two things I think that investors are looking now in the Disney narrative is theme parks, and you just brought that up, and we're going to continue to see pretty good momentum, both domestically, internationally, cruises, all of that. You got everything going there, and then streaming, right? So streaming is kind of the big thing.
Right.
We've seen some good profit, but we need more.
Geetha, thank you. Disney is a company we just love talking about with Geetha. Geetha Ranganathan of our BI team. Shares of Disney down about 2%. Coming up, we're going to talk a little bit about distressed real estate. That's coming in on Bloomberg Businessweek Daily.
It's 2:40 on Wall Street. I'm Amy Morris. We're waiting to hear from President Trump this afternoon as he's set to announce that Apple is making a new $100 billion investment in the U.S. Apple CEO Tim Cook is expected to be there. Shares of Apple right now 5.7% higher. Let's check the markets for you. We do it all day here at Bloomberg. S&P 500 0.75% higher. NASDAQ 1.2% higher, and the Dow is now 0.3% higher. The 10-year Treasury yield at 4.22%. The 2-year yield at 3.7%. President Trump has signed an executive order that imposes an additional 25% tariff on India over its purchase of Russian energy. These accelerated tariffs will be in addition to the 25% country-specific tariffs and will take effect within 21 days. This could be just the beginning. Sources say the Trump administration is also mulling over new sanctions on Moscow's covert fleet of oil tankers and the entities that enable them to operate. Advanced Micro Devices shares fell after that company failed to deliver a clear outlook for resuming sales in China, a crucial market for the second largest maker of AI processors. Shares of AMD now more than 5% lower. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Bloomberg Businessweek Daily with Carol Massar and Matt Miller.
All right, Amy, thank you so much. Amy Morris in for Charlie Pellet. Hey, a few stories with some news in the real estate space. You've got Apollo Global agreeing to acquire a majority stake in Stream Data Centers, making its first such acquisition in the alt asset manager as it really looks to diversify, I should say.
This is, I think, fascinating. Data center investments, I have so many questions.
I do too.
Yeah.
There's a lot of money going into it. A lot of money.
But how fat are margins going to be in that business? I mean, if
well,
power prices go up, who eats that? And I just don't know.
I don't know.
There are examples of companies that have done really well. Digital Bridge has really boosted its top line and has now started to turn a profit. And they do a lot of that business. So.
Everybody talks about that. We're just going to need more and more power. But you're right. I don't know. It's a good question. Our next guest, though, really focuses on distressed real estate. We kind of want to get into that, especially when it comes to mid-size multifamily sector housing. So let's get into it. Back with us is Amy Rubenstein. She's CEO of Clear Investment Group, and she comes to us from our Chicago News Bureau. Amy, good time to have you here. Last time we talked was December. There's a few things that have happened, like a new president coming in and lots of changes from the White House. Talk to us a little bit about how your market has changed. What's going on?
Yeah, we started off the year really strong. We started to see transactions pick up. And then tariffs got announced in April, and it started to slow things down again. I think people sort of took a little bit of a backseat, trying to wait and see what was going to happen. And now I think we're starting to see things normalize a little bit again. The fundamentals of affordable housing or low-income housing, workforce housing are all still really strong. Unemployment is still really low.
There is affordable housing? Where?
Well, so yes, that brings us to a great point, is we do have a massive shortage of affordable housing, which makes that market and that sector really strong.
You know, Amy, when I talk to people in the real estate world, I always get questions sent over from the reporters more knowledgeable on this space than me, and they always, well, lately they always want me to ask, does this person have enough cash saved up to go in and make the purchases? Because now is when you want to be in your industry, in distressed real estate investing. Is that true in multifamily as well? Is that true in residential as well?
Well, so the multifamily that we're dealing with, if you're talking about individuals buying housing, we are dealing with renters by necessity and not lifestyle renters that are choosing between choosing a house to purchase or an apartment to live in. And so we're never competing against that particular market. But right now, the question is for people buying multifamily is, can you get the loans? And that's, comes back to where interest rates are at right now, how banks are doing right now, and we are seeing it to be an easier market to get loans in today than we were at 12 months ago or even 6 months ago.
Well, so let's talk to you about where are the opportunities right now. Talk to us about maybe a recent deal you have done, and give us just geography, the particulars. We're always interested in that and kind of what is getting done as you work within your space.
Sure. So the last deal we bought was about 700 units in Washington, D.C. It was bought out of bankruptcy court. So there was a lot of distress in the deal in the sense that there just was not a focal point of leadership at that property for a while. Tenants were upset. The city was upset. It needed a clear focus and a path forward to get to stabilization. So we bought that deal and have since then started to stabilize, mostly stabilizing through communication with tenants, communication with the city, and really trying to then dig into where the deferred maintenance that needs to be fixed and taken care of, and how do we get to that stabilization, which is pretty straightforward when you have a property that has that type of distress on it.
You're at a shop with a great reputation, Clear Investment Group. You have raised a ton of money, right? I think you just raised another $300 million fund, and you seem like you seem like a super nice person. So how do you avoid being a slumlord? Right? At these levels, what do you do to make sure you'll make money and have a clear conscience?
Oh, absolutely. So our model is fully aligned with our tenants and fully aligned with the other stakeholders of the property, the city, the municipality. We often are buying from slumlords, not always, but often when we do see that type of stereotype, that's the kind of property that we're actually buying. So then we're stabilizing it to get to a place where we're providing safe, habitable housing for our tenants. And so that is our business model, which aligns with what those tenants are looking for. And so we're the opposite of a slumlord. We're actually trying to fix something that would cause a property to be classified in that way.
Why does that happen? And I ask that kind of naively because I want to. Is it just bad people? Is it just because the business dynamics don't really work? You guys are on a mission to make quality housing available to the working class. Like, is it just, it doesn't work on a business level or what? What goes wrong?
So what goes wrong is it can happen, a few things happen, but usually what it comes down to is the seller actually being distressed. So the current owner of the property has some sort of distress in their lives, whether that's a financial distress in some other business that they have, or a financial distress that's coming from some other form. It's usually not coming from the property itself, but some things could push it over the edge, like interest rates, like COVID. Those are the types of things that could push an owner over the edge. What starts to happen is communication starts to break down between the tenants and the landlord. The landlord stops putting money into the property, and therefore tenants start to get upset and stop paying rent. Maintenance isn't taken care of because tenants aren't paying their rent, and then more tenants stop paying their rent. And it's a really bad downward spiral that starts to happen. So I don't think it's that anybody goes out trying to achieve distressed property, but it just happens, and it happens quickly.
How are renters doing? Are you seeing stress, though, in their ability to pay rent?
You know, I think that the fundamentals right now are really strong. So for a while, we were seeing expenses rise at a very rapid pace on apartment buildings, and then also for individuals in their homes, right? Inflation was really high for a while. It has started to come down. Employment is really strong right now, so people have jobs. So where I do think it was a struggle for a little while, there was a period of time where we did see people struggling more, and I see that starting to settle and starting to stabilize now.
Amy, I want to get your take as not as an investor necessarily in this market, but just as someone who sees what's going on and understands the industry better than anybody. New York City is like unaffordable for most people, right? $4,000 is what you need to get into a one-bedroom in Manhattan. Right. We have self-proclaimed socialist mayoral candidate who's doing very well. He wants to put on rent caps. What do you think about this situation? How would you assess it?
I strongly disagree with it. I think it's really, really bad for the housing market. Because what happens is now landlords are in a situation where they can't raise they can't raise their income as much as their expenses are rising, and no one's capping their expenses. So when you get a rent control situation like that, what happens is the landlord usually will start to spend less in the property, especially when they weren't prepared for it in the onset. If you go and you buy a property that was not rent control, and now all of a sudden rent control is placed on it, your model was just thrown off. So you might not be able to have that sustainability or that wherewithal. And that's where you see landlords get into a lot of trouble. And what happens is that ends up negatively affecting the tenants themselves. So they're the ones that end up losing.
You always open up a window into certainly this part of the housing market, so really appreciate it. Amy Rubenstein, she is CEO of Clear Investment Group, joining us from our news bureau in Chicago. When we come back, we check on trading and some of the stocks on the move. Carol Massar, Matt Miller, and this is Bloomberg Businessweek Daily.
This is Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
How many donuts do you eat?
I don't eat a lot of donuts
you're so
on the regular, but if I were at Krispy Kreme, I would eat at least 3 or 4.
I will say when they used to come out and they were warm, they were kind of pretty scrumptious.
Bring them down.
I don't do donuts anymore.
They bring them down to the New York Stock Exchange. When I used to work on the floor.
Yeah. When they would do earnings, right, and things.
Yeah, they come in with like hundreds of boxes, and the traders on the floor will have contests to see who can eat the most Krispy Kreme donuts. And there are guys who are eating multiple dozen.
It's nothing against donuts,
just
but then you have like donut stomach afterwards. It's just like pancakes. If you have pancakes, it's just like, whoa.
I like pancakes too.
Of course you do. I'm Carol Massar along with Matt Miller. Let's take a look at some stocks on the move. Bloomberg News cross-asset reporter Denitsa Tsekova in the house. Where shall we begin?
We should start with McDonald's. I think it ties well, with the conversation we have. McDonald's is up 3%. Ticker is MCD. Sales picked up last quarter. They've had a number of collaboration and budget meals, and it seems that this is working. The company is up only 6% year to date, so this was much needed boost. Global sales at restaurants open for more than a year rose about 4%. This was more than the street expected. International markets are doing particularly well. What we're seeing in the U.S. is that Americans are spending more per trip. So that's helping. The results ended the quarter. There is some declining growth as the company was dealing with E. coli outbreak. There was backlash against American brands in the Middle East. There was consumer needs. And despite all of that, it seems the company has been doing well. Two interesting things that they flagged is a meal timed to the launch of Minecraft. And then their partnership with Squishmallows. I don't know if you follow those, but that's...
Those are those pillows or whatever?
Yeah. The big fluffy ones. They're very cute.
Do your kids have Squishmallows?
We have a couple, but I'm not for them.
Matt, listen, you're among friends. You can tell us you have a few on your bed that you like.
They're very cute.
We have some Labubus too.
Oh my gosh.
I have no idea.
That's a flex. Labubus.
I will say I love McDonald's French fries. And if I'm on a road trip, I go by and I'll get a nice tea.
Yeah, but have you had French fries at Five Guys?
I don't know that I love those as much.
They're delicious. Cooked in peanut oil.
Five Guys has the peanuts, right?
So healthy.
I like the peanuts. Let's get to stock number 2, Snap.
Snap. Shares are down. Obviously, the company is seeing a slowdown in advertising revenue. Advertising revenue accounts for about 90% of their revenue, so it's pretty much the whole story. Stock is down 17% today. Ticker is SNAP. There was obviously a technical issue with ad buying too. Earlier this year, the company said that second quarter sales were actually shy of what Wall Street was expected. Revenue in June was hit by what we saw in that advertising auction when they send an update. And actually, people marketed apps at substantially reduced prices. So the company says that after that, it has recovered. Advertising revenue is growing, but still a massive hit to the company, which is already down nearly 30% year to date.
Didn't Mandeep say to us?
Take a guess at how many daily active users there are at Snap globally.
Oh, wow.
Globally.
Oh,
there's a lot.
What would you guess?
500,000,000.
It's 500 million, according to Mandeep Singh.
500 million. I meant to say 500 million.
He says that there are 90 million in America.
Wow.
Using it on an everyday basis, it just sounds like too many to me.
But he also mentioned, too, that they're not a great company in terms of giving guidance. So you often see swings when they report.
Yeah, you see a lot of volatility. That makes sense.
All right, LCID, another one that
Lucid.
reported after the close last night. Lucid, yeah.
Yes, car makers have been on a tough ride. This is the latest one to temper expectations. The company expects to produce between 18,000 and 20,000 electric vehicles this year. This is down what the company projected earlier this year.
Nothing,
I
right?
could produce that many in my garage.
Yes, we can all do as much. Lucid's adjusted loss was more than the street expected. Obviously, automakers have been under a lot of pressure due to soaring costs from the tariffs. EV makers, in particular, have seen a lot of other struggles with the EV credit and a lot of regulatory pressure. Tesla has warned that this dynamic will weigh on those companies. That said, we heard about the robotaxi launch that is together with Uber that is expected in 2026. So maybe that would be potential boost. But for now, stock is down nearly 30% this year.
Is that going to do it, Matt? If they've got a midsize EV and the Uber or robotaxi launch, is that going to change its fortunes?
No, absolutely not. And I'm not an analyst. I'm not giving out investment advice.
I hope not.
But this stock is just a big loser. I mean, it's being literally decimated today. It's lost a tenth of its market cap, and it already had taken an absolute beating. If you look at the COMP function, you can see it's lost 78% of its value over the past 5 years. So,
ouch.
It's been painful.
This is a surprising one to me too, because when they did their IPO, which was a SPAC thing, they had Alan Mulally on the board. And that's a guy who turned around the Ford Motor Company, arguably one of the best operators in automotive history. And still.
Yep. And more than 30% of the float is short, so there's a lot of negative sentiment. Bloomberg News cross-asset reporter Denitsa Tsekova. Check out our Stock Movers podcast, 5-minute episodes of the biggest winners and losers in the market. Stock Movers on Apple, Spotify, or anywhere you get your podcasts. That's going to do it for this hour of Bloomberg Businessweek Daily. The close coming your way on TV. We continue to watch earnings, that Apple investment news. Do not go anywhere. This is Bloomberg.